Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London UK feed wheat. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of the patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, Paris milling wheat. And the market here is somewhat different when compared to the ones in the US, though there had previously been some similarities. The first common feature was the idea of a rounded bottom pattern from June last year to March this year, something I floated on the other grain markets. For this one here, I looked to the June 25 high at 221.5 as being the key level for the lip of the rounded bottom, just above the super significant 50% absolute Fibonacci line at 218.75, which capped prices with a small double top in mid-March. Thus, so far, we have not triggered any intention of an upside move. Instead, the market has formed what looks like a possible bear channel. It's currently 203 to 213.5 from the small double top. This would seem on the surface to thereby cause the big rounded bottom pattern idea to fail, but not so fast. You see, many rounded bottom patterns have a handle or extension to them, to the right-hand side of the construction. And this is what we are seeing here. Now, the only issue is the steepness, the bearish steepness of this handle. You see, the flatter the handle, the better the pattern, and this one is quite steep. However, prices are now coming down to possibly some hopefully significant support from the rising green short medium moving average, currently at 203 even. It will be interesting to see if this moving average manages to temper the decline, or whether it fails, and we see a different beginning of a pattern. Minneapolis wheat. 6 weeks ago, I applied what I said at the time, and I quote, "It is an old technical analysis technique, but one which I recall worked well in the grains during the start of the Russo-Ukrainian war back earlier this decade. And that is doubling, tripling, or even more of bull channels. In this case, specifically the mid-January to late February bull channel. Now, tripling this higher, currently at 631.25 to 651.5, gives another topside resistance above the next resistance at the April 2024 low at 634.75 and close to the 38.2% Fibonacci line of the May to August 24 move at 644.5. Making it quadrupled up bull channel gives us currently 650.75 to 670.25. And that's the end of the quote. Well, doubling up the bull channel gave a very limited resistance, as did tripling up the bull channel for a while, but quadrupling up the bull channel, well, that showed promise with the upper bull channel line there being pierced, but not broken until last week, when prices dropped back down to doubled up bull channel line. Before this week, making a strong move higher and setting up the market to possibly make a weekly key reversal. Thus, if we close tonight either over 660.5, which looks entirely likely at the moment, or over 627, then we'd be on. Right now, we are looking at a weekly key reversal ups. This brings us to the bigger picture here, and we have the same rounded bottom pattern here that was seen in the other grain markets, based on the November 2017 high at 665.75, which in turn gave us the June 25 high. That was the start of the rounded bottom. However, I would also add the 50% Fibonacci line for the May to August 2024 move that is nearby and a little higher at 669.5. We've seen this to be key to the attempts higher being pierced, but only have had a single close over it since the start of March. Now, as I've said elsewhere, though we have not broken higher from this rounded bottom pattern, this is not necessarily a bad thing, as rounded bottom patterns sometimes have, as here, they form a handle or an extension to the right-hand side of that rounded bottom pattern. And that is what we have seen since early March. I'm now wondering if the weekly key reversal up we are seeing being built here may be the spark that ignites a possible move higher over the 50% Fibonacci line at 669.5. It is worth paying close attention to this market for the next week or so because of just this. London UK feed wheat. Since the peak in mid-July last year, prices have moved lower, below the very, very important dark blue neckline extension on my daily chart, currently at 169 even. A neckline to a pair of very long-term patterns which I will shortly detail. However, what was really happening was the formation of a July 25 to date very large rounded bottom pattern, with a first peak at the 50% absolute Fibonacci line at 180.5. In addition to all this, I drew some weeks ago a bright green late January to mid-July 25 quite shallow bearish shift pitchfork to hopefully show the newer bearish angle of attack I thought might be there. But this pitchfork has been disappointing, and as I said 12 weeks ago, and still is valid, and I quote, I really don't think this pattern adds much to the conversation right now. End of quote. We are now sitting above the bright green upper tine, which is currently at 173.25, and unless something major happens in the meantime, I will retire it for next time. Instead, the most recent pattern driving this market high has been a bright red March to date bull channel, small bull channel, currently 174 to 179.85. This continues to be the pattern to watch in the immediate future, though I will draw your attention just above the upper bull channel line to the middle tine, which is currently 180.05. It's not highlighted as yet, but that's of an end of June, end to late October 2025 bullish shift pitchfork. This pitchfork has so far not been tested, so this will be the first if we continue to move higher. Okay, so that all being said, this leads me to my final points, and they are the same points I've been discussing here for well over a year, as some of them were something that I noted back in my annual commentary back in January 2025. To see these, it is best if we switch to my longer term monthly chart. Firstly, we saw back then the potential for a very large May 2023 to April 25 bearish cat's ears pattern. Now that's akin to a double top, but formed after a long big fall such as the fall we had in early 2023. As well as this, we have an even longer term second pattern, an August 2020, April 25, very large head and shoulders top pattern. These two super long term patterns both rely on one single feature, and that is their common neckline, highlighted in purple on my monthly chart here, currently at 169 even, same as on the daily chart I just spoke about. Thus, from these two longer term bearish patterns, we have a primary target X3 for the bearish cat's ears pattern, that would be down in the 127.5 zone, and a secondary harder to reach target X4 down in the 112.85 zone. Now for the head and shoulders top, we even lower primary target X5 down in the 64.20 zone, close to where sits the oldest uptrend I have on any of my 200 or so charts, the 1975 to date. Yes, a half-century old uptrend I have, and that's currently at 66.20. I am not even going to give you the secondary harder to achieve target for this pattern as it's below zero. Please, please, please bear in mind that these are very long-term targets, stretching possibly over many years, but they are still targets below for these patterns above. Now, that all being said, July 2025 with changeover threw a major spanner in the works for such longer-term patterns. The reactionary immediate countering monthly key reversal up for July last year went back above the purple neckline, but stopped at the 50% absolute Fibonacci line at 180.5 and just under the bright green 2023 to date bear channel, and that's currently at 170.95. Now this is the same as the purple downtrend seen on my earlier daily chart, the one that the market pushed up over in mid-March and has stabilized over in April. The question this posed, and it's a longer term question, is whether July 2025 was a reactionary single month move higher or the beginnings of something else. I am now more than ever before of the opinion that these two bearish patterns will not be the way forward, and that we have a base for a move higher. March provided a single monthly close over the bright green upper bear channel line. Now we need to see if prices can build on that move confirm it, stabilize over it, especially if prices can overcome the next significant resistance, which is the 50% absolute Fibonacci line at 180.65. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpick and ADM Investor Services International Limited. And here comes the final important bit.